Hi, I'm Steve, and welcome to Bytes by Standard Chartered's Global Chief Investment Office. Should investors be worried in 2026? We remain constructive on risk assets this year. That said, we believe 4 key risks warrant investors' close attention. Looking at the unprecedented number of geopolitical developments that have unfolded over the last 2 weeks, it wouldn't be an exaggeration to say that 2026 is off to a high-octane start. Amid this backdrop, our 2026 outlook for financial markets remains fundamentally constructive. We expect equities to continue to inflate, bonds to be an attractive source of yield, and gold and other alternatives to perform their expected roles as portfolio diversifiers, despite some speed bumps along the way. After 3 consecutively strong years for risky assets, it's only fair to question what factors could pose a threat to this outlook. Let's discuss what could go wrong in 2026 and what investors can do to safeguard themselves from these risks. Here are the 4 key risks that we believe are worth monitoring as the year progresses. First is the risk of a significant, and potentially systemic, credit event. In such a scenario, a default event triggers contagion across markets because of investor linkages that turn what could be a standalone default event into a more systemic risk. Second is the risk of an unexpected inflation rebound resulting from one of several potential triggers: stronger than expected economic growth, the transition to a new Fed chair, or the introduction of new trade policy measures. Third is the risk of reduced global liquidity as a result of the Bank of Japan's monetary policy tightening. Many reports have pointed to the gradual creep higher in Japanese government bond yields, which have now moved higher than comparable bond yields in several other key markets, such as China. Fourth is the risk of a significant AI disappointment. Given the tremendous focus on AI in recent years, investors seem preoccupied with the question, is the AI boom a bubble waiting to burst? Our biggest concern is bullish expectations rising to a level so high that even a very good earnings or investment outcome results in a disappointment for markets. Portfolio strategy, where optimists and pessimists meet. In the context of the key risks, a mix of 3 approaches can enhance portfolio resilience. Adding alternative strategies as diversifiers. Gold remains the most popular alternative in recent years, given the growing demand from central banks, but other major alternative strategies can help build diversified sources of return that can perform well in various scenarios. Looking beyond US, primarily technology, within equities. While we expect the market to continue performing well, adding non-US equities provides additional sources of return that are less correlated to the AI theme. Considering an allocation to EM local currency bonds. While most USD-denominated bonds are ultimately influenced by Fed policy, non-USD bonds offer exposure to different interest rate cycles, while benefiting from our expectations of a weak US dollar. Given all of the above, our 2026 outlook is that of optimism, while we hedge risks through diversifiers and alternative strategies. Thanks for watching. See you in the next episode.